Nvidia's earnings are out, the conference call is over, and we have a lot to talk about. Because Nvidia stock is down almost 7%, which is less than 9%, which was priced in, but still having a pretty negative effect on broader markets, with the S&P currently down about 0.6%. And the big question is, was this good? Was this bad? So I will give you just the raw numbers here first, and then we'll break it down a little more. Nvidia's revenue beat estimates by quite a bit, by about 1.2 billion. Revenue came in at 30.0 billion. Estimate was 28.86 billion, so that's good. Adjusted EPS came in at 68 cents versus 64 cents, which was the estimate. That's good. Adjusted gross margin came in at 75.7%. versus estimates of 75.5%. That's good. Data center revenue, 26.38 billion versus estimates of 25.088 billion. Really good. Gaming revenue even beat. Came in at 2.9 billion versus estimates of 2.79 billion. For guidance, Nvidia sees Q3 revenue 32.5 billion plus or minus 2% versus the estimates of 31.9 billion. That's not an Nvidia-like guidance this time around. Yes, they still did raise their guidance, but it's only about $600 million that they actually raised guidance. Last quarter, Nvidia raised guidance by about $2 billion, and every other quarter before that, it was over $2 billion. So this is definitely a strong report, but weaker in the sense of those forward guidance raises are getting smaller. But I think the real pain from this report is in the margin. Nvidia sees Q3 adjusted gross margin of 74.5% to 75.5%. The estimate was 75%. So Wall Street was expecting this current quarter to be 75.5%. Great. They were expecting next quarter's margin to be 75%. Nvidia beat margins for this quarter, coming in at 75.7%. But on the low side of their guidance for Q3 margins, you're at 74.5%. So Nvidia is kind of guiding lower to a point with margins. And if you look at the low side of guidance, that could be a margin decrease of 1.2% if they come in at the low side of Q3 margins. Now, at the midpoint, the actual guidance is going to read at 75% because you take the midpoint of 74.5% and 75.5%, you're at 75%. But that's not beating estimates. That is matching estimates. And for Nvidia, that's not good enough. Other headlines include many customers are waiting for Nvidia's next generation AI chip called Blackwell. Nvidia said it shipped samples of Blackwell chips during the quarter and made a change to the product to make it more efficient to manufacture. Quote, in the fourth quarter, we expect to ship several $1 billion in Blackwell revenue. That is Nvidia's CFO said that on the conference call. They say, quote, the change to the mask is complete. There were no functional changes necessary. And that's what Nvidia CEO Jensen Huang said on the conference call. He also says, quote, when I said start production in Q4, I meant shipping out. And I don't mean starting to ship. He continued. They also say that Hopper demand remains strong and the anticipation for Blackwell is incredible, said Nvidia CEO Jensen Huang in the press release. Nvidia noted that supply for Hopper is becoming more available while Blackwell is still in short supply. Gaming revenue also increased 16% from a year ago to 2.9 billion, as we mentioned in the peer numbers we just shared. The company's professional visualization business rose 20% and reported 454 million in revenue. Nvidia also reported 346 million in automotive and robotics revenue versus Wall Street's expectations of 344.7 million. So across the board, things were good for Nvidia. Again, it looks like the main concern that Wall Street has is the lower than expected margins for next quarter and the guidance on revenue, which was just not that impressive. Yes, it was $600 million higher than Wall Street was expecting, but when Nvidia usually raises guidance $2+ billion a quarter, is $600 million that good? Is that impressive? it really didn't stand out to me. Mixed margins with a okay but not great guidance from Nvidia standards. And yeah, you could see the stock pull back a bit from here, and that's what you're seeing here in after hours with Nvidia down around 6.5%. Now, is this the end of the world for the markets? Probably not, but when you mix in September seasonality, which, yeah, September is historically a very rough market, time for the markets. Over the past 10 years, September is on average down 2.6%. The only other month that is negative over the last 10 years is December, and that's negative 0.2%. Like, September is 10 times worse than December over the past, more than 10 times worse, like almost 15 times worse than December over the past 10 years. Big declines tend to happen in September. This is also an election year. So with Nvidia down and really not impressing investors, that was a big potential catalyst that was potentially missed opportunity, at least from the bulls' perspective. We do have some economic data coming out tomorrow morning, which is important to also recognize. Tomorrow morning, we have the GDP growth rate quarter over quarter, the second estimate for Q2. We're expecting 2.8%. If that number comes in lower than expected, that's going to be insanely problematic for markets from a growth perspective. So I think that is a potential risk for tomorrow. Initial jobless claims are expected to come in at 232,000. Last week, you were at 232,000 as well. If that comes in a little high, I don't think it's a problem. If it comes in too high, then that's a problem. Obviously, if it comes in at expectations or lower than expectations, that's going to be viewed as a positive. Continuing jobless claims are expected to rise about 7,000. I don't think that's going to be too big of a deal. And all of that data comes out at 8:30 in the morning tomorrow. You are expecting pending home sales month over month and year over year that will come out at 10 o'clock in the morning as well tomorrow. Although I think the main story is going to be Nvidia. It's going to be big tech, potentially AI taking a little bit of a breather here, to the extent of how low could Nvidia go. I mean, you're down 7%. If there's more selling pressure that kicks in tomorrow morning, then that becomes a bigger problem. If we kind of bounce a little bit and let's say it's only a 3%, 4% negative day tomorrow, and then we get over it in the following couple of days, well, that's not going to be nearly as bad. But again, we have September seasonality risk. We also have the election and drama in the Middle East. Who knows? Iran could attack Israel at any moment, and we've heard that for a while now, but still that is a risk for markets at this point. You have Fed Bostic that speaks at 3:30 p.m. tomorrow. That's also going to be important if he says, anything that has to do with raising rates or the economy. Markets are going to pay very close attention to that. And then out of Japan, we are going to have the unemployment rate as well as CPI that will come out. Japan, the carryover trade, I know I say carryover trade because that's more like what it is, but it's the Japanese carry trade. It imploded on August 5th. It was like Tokyo's Black Monday. It was a really bad day for global markets. And it's not over with. There's still a lot of money out of that trade that needs to unwind. And if Japan CPI comes in too hot, the Bank of Japan may be forced to raise rates, and then you have that whole debacle all over again. On Friday, just to mention it while we're here, you do have the PCE index that will be coming out, as well as Chicago PMIs and final data for the Michigan Consumer Sentiment Survey. So we still do have some data throughout the rest of this week, and that will still be important, even though Nvidia did report earnings, and that was really the biggest catalyst for this week. Tomorrow morning, you have Best Buy, Dollar General, American Eagle Outfitters, Ollie's, Campbell's, Burlington, Birkenstock, 1800 Flowers, and a couple of others that report. Thursday and after hours, you have Dell, Lululemon, Ulta Beauty, Marvell, Gap, Autodesk, MongoDB, and others. But what you will notice is while the S&P is down 0.58%, the equal weight S&P, the RSP, is only down 0.1%. So it's not as bad for the equal weight S&P than the market cap weighted S&P. And from that perspective, Nvidia or big tech selling off could actually be a positive for small caps, mid caps, interest rate sensitive companies. For Tesla's sake, Tesla probably will be grouped in the large cap category, with Tesla stock currently down about 1.4% in after hours. But if you do own other stocks, it wouldn't surprise me to see a little bit more of a broadening of our markets. As long as the economy stays good and we're not going into a recession, I think a broadening out here makes a lot of sense. Again, especially after Nvidia just had this 6.5% sell-off following earnings. So I definitely think there's a little bit more risk now that Nvidia just got taken out of the spotlight a little bit, at least for the headline S&P. Again, I don't think this matters too much for the RSP, the equal weighted S&P, but time will tell and we will see. Let me know what you think is coming next for markets down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.